Day 1 of 365 Days Learn Trading.
Topic 1. What is trading? Spot versus futures. What is spot trading? Spot trading is the most basic type of trading. You buy the actual cryptocurrency and it gets added to your wallet. Example, you buy 1 Ethereum at $3,000. If ETH goes to $3,500, you've made a $500 profit. You must wait for the coin to rise to make money. If the market drops, you're stuck in a loss. What is futures trading? You are not buying the real coin. You're making a deal on the price movement of the coin. You can make money if the price goes up or down. This is the key difference. It works like this. I think Bitcoin will go up. I open a long. I think Bitcoin will drop. I open a short. Example, you short BTC at $70,000. BTC drops to $68,000. You close the short and keep the profit, even though you never owned any Bitcoin. Why do people love futures? You can make money in both directions. You can use leverage to increase profit from small price movements, but it is riskier. You can lose fast if you don't know what you're doing. Important terms. Open position. When you've entered a trade, long or short. Close position. You end the trade and lock in profit or loss. Summary. Spot. Real coin. Profit only if price goes up. Futures. Bet on price up, down. Profit in both directions. Topic 2. What is leverage? Why 20 times? Leverage equals borrowed power. You use small money but trade big size. Think of leverage like using a car jack. Your hand is weak, but the jack lifts the car. How it works. You have $10. You use 10 times leverage. You control $100 worth of coin. If the coin goes up 1%, you earn 10% on your money. If the coin goes down 1%, you lose 10%. Leverage versus risk. Higher leverage equals faster profit, but also faster loss. If the trade goes against you, your position can be liquidated. You lose it all. Liquidation. Explained. Let's say you long BTC at $70,000 using 20 times leverage. You put in $10, so your position is $200. If BTC drops just 0.5%, your $10 is wiped out and the trade closes automatically. That's liquidation. Why do people use 20 times, 50 times, or even 100 times? They want fast scalps, enter and exit in 10 to 60 seconds to catch tiny profits. But this is not for beginners. Beginners should use low leverage, 2x to 5x, while learning. Summary. Leverage. Borrowed trading power. Higher leverage. Higher speed, higher risk. Start low, build confidence, then test higher levels. Topic 3. Long versus short. How you earn. What does long mean? You expect price to go up, so you buy the position. Example. You long ETH at $3,000. Price goes to $3,200. You close and profit. What does short mean? You expect price to go down, so you sell the position. Example. You short BTC at $70,000. Price drops to $68,000. You profit on the fall. When to long versus short? Long when. Market is bullish, strong buying. RSI is low, below 30. Price breaks above resistance. Short when. Market is bearish, strong selling. RSI is high, above 70. Price hits resistance and falls back. You don't need the coin to rise to make money. That's why futures is powerful. Summary. Long buy if price will rise. Short. Sell if price will fall. You earn based on price movement, not coin ownership. Topic 4. Order types, market versus limit orders. Market order. You buy, sell instantly at the current market price. Good when. You want fast entry. Market is moving quickly. Bad side. You may get a slightly worse price due to slippage. Limit order. You set your own price. Your trade only opens if the price reaches your level. Good when. You want control. You're placing a trade while waiting for price to pull back. Example. BTC is at $70,000. You think it will drop to $69,800 before rising. You place a limit long at $69,800. If the price touches $69,800, your long opens. Bonus tips. Scalpers often use market orders for speed. Swing traders prefer limit orders for precision. You can set take profit, TP, and stop loss, SL, with both types. Summary. Market order, Ts, fast, instant, less control. Limit order, Ts, slower, but more precise entry. Recap of Day 1. You now understand the difference between spot and futures, what leverage does and why it's risky, what it means to go long or short, how to use market versus limit orders.